Hi, everyone. Hi. Hello. I'm attorney Aiden Kramer with the law office of Aiden H. Kramer in Colorado, and you're watching All Up in Your Business. And look, it's my buddy Rocky. You guys remember my old buddy Rocky, right? You can see his big white butt right there. Well, what Rocky and I are going to talk about today is using umbrella LLCs or holding companies and subsidiary companies and why one would do that and what benefit and advantages they provide. And so to help explain that, I'm going to do something really special. You know it, you love it, you missed it. I'm going to bring in some nice graphics. Here we have a basic illustration of what a kind of simple umbrella or holding company structure might look like. So here we have obviously business owner, BO stands for business owner. Well, I mean, what else would BO stand for? And BO owns one LLC, LLC1. He is the only owner, the single member in this LLC. And this LLC1 would be typically referred to as the holding company. And then LLC1 owns LLC2 and LLC3. Those are normally referred to as the subsidiary companies. LLC1 might also be called the parent company, and I say this as LLCs, but this is also very common with corporations or having the corporation be the holding company and the LLCs subsidiaries. You can do it with really any sort of business entity. So that business owner owns LLC1, but LLC1 owns LLCs 2 and 3. LLC1 is the only owner, the only member in these other two. So these other two LLCs are considered single member LLCs. Now, there are two primary advantages to doing this. The first is for liability protection. So if you're operating a business, or if you're operating a few businesses, or if your one business has kind of different types of operations that it does, then this would be something that you might want to do, is separate each business or each business function or operation into its own LLC or corporation. The reason you would want to do that is because then the liabilities of one company or one LLC won't hopefully affect the assets of the other LLCs. So let's just say, for simplicity's sake, that you're operating 3 different businesses but under one LLC. If somebody sues you because of one of the business functions that you're doing, then obviously the assets of the other 2 businesses are going to be liable for that lawsuit or those liabilities because they're all under one LLC. They're really under one business entity. So by separating them out, you're separating the assets and separating the liabilities to hopefully protect each asset and insulate each business from the liabilities of each other one. So if there's a lawsuit over LLC2, the assets of LLC3 and LLC1 and BO will hopefully be protected from those liabilities. And then the other benefit of doing this is a tax benefit. That's why I wrote taxes there. If you can't read that, that says taxes. Single member LLCs are considered disregarded entities. That means the income to the LLC is basically treated as if it's income to the business owner. It's a pass-through entity. The profit passes through to the business owner. So if BO here owned 3 LLCs, but they were all 3 separate LLCs, he would basically have to file a tax return for each separate business, and that could get kind of cumbersome and taxing. It could be very taxing to have to do that. That's funny. I just came up with that. That's funny. But since LLC2 and LLC3 are only owned by LLC1, they are single member LLCs. So the profit from a tax standpoint passes through to LLC1, and then that passes through to the business owner. So the business owner now only has to file taxes for one business because it's all passing through LLC1. So that's another benefit of structuring something this way, is for the tax simplicity. So structuring a business or multiple businesses or multiple business operations in this manner can be a good idea, and it can help protect the assets of one of the business functions, one of the LLCs, from the liabilities of one of the other ones. It's definitely not perfect, just like any other LLC. It's not absolute liability protection. You are still subject to piercing the corporate veil in these situations and to reverse piercing the corporate veil. So LLC 1 could be still liable for LLC 2 or 3 if somebody decided to pierce the corporate veil. Then the assets of LLC 1 could be subject to that. And it could potentially go the other way, where LLC 1, if they were subject to a lawsuit, then LLC 2 and 3 could be at risk as well, because those are the assets of LLC 1. So it's definitely not perfect, but it can really help you liability-wise and legally and tax-wise. So I hope that helped explain it. I know it's kind of a complicated structure, and if you're thinking about doing something like this, I really recommend working with an attorney, because it's really easy to screw these up and just have a whole big mess on your hands. So if you guys have any other questions about that, feel free to comment them. If you're in Colorado and you want to speak with me personally about your business or starting an LLC or subsidiary LLCs and whether that's the right thing for you, feel free to contact me. My phone number and email are below. Otherwise, thank you all so much for watching. I'm Aiden Kramer, and this is Rocky, and we'll see you next time.